Hello, Theo traders. This is Gianni Depoce, and today is the 30th of April, 2024, and stocks and a lot of risk on assets are on the retreat today. And over the last couple of weeks, I've been an advocate for buying the dip, but with the prospects of a secondary lower high forming here in stocks, we need to be cautious with respect to the possibility of this buying the dip turning into selling the rip. So I'm a little more cautious now than I was in the last couple of weeks. But that being said, it's not the end of the bull market yet. I have the S&P 500 here. You can see that we broke down from what looked to be like a mini rounding top formation. We satisfied and actually even exceeded the downside price objectives. We had a downside target of around 5,000, 5,050. We dropped as low as 49.63 on that latest decline, but we came back up and were rejected at former support turn resistance. Now, whenever support breaks, it becomes resistance. And so this is a big concern with respect to the health of this bull market because we have the prospects of a lower high, which is the first step in the establishment of a downtrend. And if you take a look at the NASDAQ here, it is leading the sell-off to the downside a little bit, which is also concerning. Tech has a tendency to lead. So I can't say that I'm all too excited about this latest price action, but until we actually break support and make a lower low, this is just a warning sign. So I want to be very clear. I'm not a bear. I'm neutral. We want to see higher highs and higher lows. We did just see a higher low, but now we saw a lower high. So the trend previously, which was bullish, is now mixed. And this can make for a really tough trading environment, very sloppy. But I'm also going to jump over to the crypto sector because if you look at Bitcoin here, crypto has been a really nice leading indicator with respect to risk appetite in stocks. And we're on the precipice of potentially breaking below a rounding top formation. Now, this could take crypto, Bitcoin. My downside target before was in the $50,000 to $55,000 area, but this pattern is actually pointing to a potential drop into the $45,000 zone. So that's even a little more bearish than before. Now, there's a lot of bullish call it, as a matter of fact, bullishness in Bitcoin. I was kind of the persuasion a couple of weeks ago that the low had been completed. But now with the prospects of closing at a new low, I'm a little more skeptical than I was and did have some stops trigger on names like MicroStrategy and Coinbase. So no longer in those. But, it's not all doom and gloom in the market. We've been talking about Apple stock. This has been doing pretty well. You have names like Google, which we've been bullish on since March 7th, hit a new all-time high on Friday. It's coming down, to seemingly form another higher low. So it's not all doom and gloom underneath the surface of the market, but it's definitely a bifurcated tape. It's not all good. It's not all rainbows and butterflies. So we have to be highly selective. It's very much a stock picker's market. Now take a look at Tesla as well. Big gap up. I would venture to say that we've seen capitulation on behalf of the bears. And they got squeezed. They got squeezed higher. And now what was looking like a breakdown from rounding top, as the saying goes, from false moves come fast moves. And Tesla could emerge as a new leader. Now, as we look across the Magnificent Seven, take a look at names like NVIDIA. This is not a stock that's in a topping formation. This is a good sign because when you start to see leaders in the bull market roll over, that tells you that a significant drop is coming. Take a look at Super Microcomputer. You could have a lower high here as well. So again, some caution is warranted. And, in terms of what we may need to be prepared for in the equity space, it's the potential for a 15 to 20% pullback. So if you go look at the S&P, that implies that you could see the S&P fall to anywhere between 4,500, 4,600, let's call it. So anywhere in that range, I think is a good target for a potential low. But that's only under the premise, the assumption that we take out the lows from the 19th of April. So some caution is warranted. But the big news to start this week is in the currency market. And this is something that I've been talking about and been very adamant about for months. And it has to do with the Bank of Japan. They are losing control. There was another suspected intervention, unconfirmed, but a suspected intervention on behalf of the Japanese yen, on behalf of the Bank of Japan onto the Japanese yen after it rallied to a new multi-decade high. against the US dollar. It was a really wide trading range yesterday. A $6 trading range in a currency market is absolutely enormous. But I'm still bullish on the dollar against the yen. I'm still very bearish the yen. Central bankers, contrary to popular belief, cannot actually make or break a trend. They can manipulate it, they can extend it, they can exaggerate it, but really, I think what the market is doing is they want to force the Bank of Japan's hand. They want the Bank of Japan to end NERP. They want them to raise rates. We have inflation at multi-decade highs. The game's over. The grift is over. Bank of Japan, it's time to raise rates. And unless they do so, the market, the forces of the market are going to punish the Japanese yen. And could we see a collapse in the Japanese yen? Could we see a potentially even hyperinflationary event? I know that might sound dramatic, but if you know your Japanese monetary history, the governing body of Japan was incapable of issuing their own currency for a few hundred years. They actually used bags of rice once upon a time as currency in Japan because of the abuses of monetary policy from governing organizations. So history doesn't repeat, it rhymes, but I'm wondering if something along those lines is happening again. And you take a look at the euro against the yen, the same thing is happening. This actually hit a new all-time high. So despite all the euro's problems, it's still evidently not as bad as what's going on in Japan, considering they have 250% debt to GDP. How can they raise rates? They're trapped. There's going to have to be some sort of sovereign default, perhaps, and that's probably going to permeate across the entire financial market. So that could be the risk that markets are discounting right now. And if you take a look at treasuries in the US, they had a 2-day corrective rally. I think they're still starting to discount this risk, and it's bond market risk, right? The risks in bonds are unlike they've ever been before if you look back at the last few decades. So I'm looking for bonds. You're seeing duration lead the way lower, which is, it's more sensitive to inflation expectations and risk, premium, so to speak. But I'm looking for bonds to take out or even just test those lows from October. And I think that's going to be a pretty tough rock to swallow for stocks. Now, the big question is, will there be a refuge offered for traders in the energy market? I was curious about crude oil potentially completing at a low significance last week, but I'm not as convinced now. We might have one more lower low to make, but if we look back at the market from 2022, we did see energy offer a brief bright spot for traders to hide. And some of the names in the space, you're seeing some big sell-offs today in names like PBF, MRO, and SM Energy. But I would be a little cautious to, throw out the baby with the bathwater, so to speak, on this energy trade. I think it still has some good risk reward set up. And if we do see interest rates continue to spike, then I think some of that money will flow into commodities and it could make for some good tradable opportunities. So we're going to be keeping an eye on that. And of course, consumer staples as well. I've been in this Pilgrim's Pride Corporation for quite some time. They have earnings tomorrow, so curious to see how that works out. It's consolidating near the highs. And when in doubt, zoom out. You take a look at this monthly chart. It's really holding up near the highs here. It's testing its resistance going back a decade. So this is pretty significant. So I'd keep an eye out for Pilgrim's Pride, especially consumer staples names. You could see a flight to safety trade unfold. Normally, you could look for utilities and even healthcare sometimes to do well in a down, in a risk-off market. But with interest rates in the rise, I just have a tough time believing that utilities are going to hold up all that well. So that takes care of everything that I want to review with you today. So we're neutral now. We're not bearish. Lower high in stocks. The integrity of the bull trend, I would say at this point, may be violated. So tread carefully. Let price guide your actions. Mind your stops. Risk management is number one. As a trader, that is our real job title, is risk management. But aside from that, that's all that I had to review with you today. So I will catch you next week and hope to see you in the TheoTRADE chat room.